Welcome back. In this lecture, we're covering bond risks. Every bond investor needs to understand what can go wrong. And trust me, the test loves asking about this. We'll walk through each major risk type, see which bonds are most affected, and connect it all back to investor suitability. Let's get into it. Here's something that surprises new investors. All bonds carry risk. Yes, even US Treasuries. They're not risky in the same way, but they're not risk-free either. Different bonds have different risk profiles. A corporate junk bond faces very different dangers than a Treasury bill. Understanding these differences is essential for matching the right bond to the right investor. That's suitability, and it's a big deal on the exam. Let's start with the big one, interest rate risk. This is the risk that interest rates rise, causing your bond's price to fall. Remember, bond prices and interest rates move in opposite directions. Here's what matters. Every fixed-rate bond has interest rate risk, no exceptions. But some bonds have more than others. Longer maturity means more interest rate risk. A 30-year bond will swing more in price than a 2-year bond when rates change. Lower coupon also means more interest rate risk. Why? Because you're getting less cash flow along the way, so more of your return depends on that final principal payment far in the future. The extreme case? Zero coupon long-term bonds. They have the most interest rate risk of any bond type. No coupon payments at all, and you wait decades for your money. That's a concept the test will check. Next up, credit risk, also called default risk. This is the risk that the issuer simply doesn't pay you. They miss an interest payment, or worse, they can't return your principal. Credit ratings measure this risk. Agencies like Moody's and S&P grade issuers from AAA down to junk. Here's a key distinction. US Treasuries have no credit risk. The federal government can print money to pay its debts. But corporate bonds and municipal bonds? Their credit risk varies by issuer. A blue-chip company is different from a struggling startup. And remember the trade-off. Higher yield usually means higher credit risk. If a bond pays significantly more than Treasuries, ask yourself why. The market is pricing in the chance they might not pay you back. Now let's talk about call risk. A callable bond gives the issuer the right to redeem it early, before maturity. When does this happen? When interest rates drop. Think about it from the issuer's perspective. They're paying you 6% on an old bond. Rates fall to 4%. They'd love to pay off that expensive debt and issue new bonds at the lower rate. Great for them, bad for you. You lose your higher-yielding bond and now have to reinvest at those lower rates. That brings us to the next risk. Reinvestment risk is the risk of having to reinvest your cash flows at lower rates. This affects your coupon payments and any bonds that get called. Bonds with higher coupons actually have more reinvestment risk. More cash coming in means more money you need to put back to work. Here's an interesting twist. Zero coupon bonds have no reinvestment risk. There are no coupons to reinvest. You buy at a discount, hold to maturity, and collect the face value. Simple. But remember what we said earlier. Zero coupons have maximum interest rate risk. So you're trading one risk for another. The test likes to check if you understand this trade-off. Inflation risk, sometimes called purchasing power risk, is the risk that inflation eats away at your real returns. Bonds pay fixed amounts. If you're receiving $50 a year in interest, that $50 buys less and less as prices rise. Here's a simple example. You own a bond paying 3%. Inflation runs at 4%. Your real return is negative 1%. You're actually losing purchasing power. Long-term bonds are most vulnerable because inflation compounds over time. One solution? TIPS, Treasury Inflation-Protected Securities. Their principal adjusts with inflation, protecting your purchasing power. Liquidity risk is the risk that you can't sell your bond quickly at a fair price. You might need to accept a lower price just to find a buyer. Treasuries are highly liquid. Huge market, constant trading, tight spreads. But municipal bonds and small corporate issues? Much less liquid. Fewer buyers, less trading activity. One indicator of liquidity is the bid-ask spread, the gap between what buyers offer and sellers want. A wide spread signals low liquidity. You'll pay more to get in and get less when you sell. Now we get to risks specific to mortgage-backed securities. First, prepayment risk. When you buy an MBS, you're receiving payments from a pool of mortgages. Homeowners can pay off their mortgages early, and they tend to do this when rates drop. They refinance at the lower rate. That's prepayment risk. Rates fall, prepayments increase, and you get your principal back sooner than expected. Sounds nice, except now you have to reinvest that money at those lower rates. It's similar to call risk, but happens gradually as homeowners refinance. Extension risk is the opposite problem. When interest rates rise, homeowners stop refinancing. Why would they? They're locked into a lower rate. So prepayments slow down, and you're stuck holding that MBS longer than expected. Your principal is tied up in a below-market investment while rates have moved higher. You'd rather have that money back to invest at the new higher rates, but the homeowners aren't cooperating. Let's put it all together by bond type. Treasuries face interest rate risk only. No credit risk, highly liquid, not callable. Corporate bonds add credit risk and often call risk on top of interest rate risk. Municipals have credit risk, interest rate risk, call risk, and often liquidity risk, since they trade less frequently. Mortgage-backed securities face prepayment risk, extension risk, and interest rate risk. They're complex instruments. And zero-coupon bonds have maximum interest rate risk, plus something called phantom income, where you owe taxes on interest you haven't actually received yet. Let's wrap up with the essentials. Interest rate risk affects all fixed-rate bonds. Longer maturity means more of it. Credit risk applies to corporates and munis, not treasuries. Call risk and reinvestment risk work together. Both hurt investors when rates fall. For mortgage-backed securities, falling rates mean faster prepayments. And zero-coupon bonds sit at one extreme. Maximum interest rate risk, but zero reinvestment risk. Know these relationships. They're tested frequently. Thanks for watching. If you found this helpful, you can sign up for the full course and 6 mock exams. There's a link in the video description. And if you want a discount, check the channel description.